There's a rule in modern business that most people believe is a law of nature. You hear it on the news, you see it in boardrooms, and you feel it every time a company cuts quality to save a few pennies. The rule is simple. A corporation's only purpose is to maximize value for its shareholders. If a CEO raises wages, they are stealing from the owners. If a company spends too much on safety or innovation instead of dividends, they are failing their duty. We are told that this is how capitalism works. We are told that this is how it has always worked. But that is a lie. The idea that a company exists solely to enrich its shareholders is not an ancient economic truth. It is not in the Constitution. In the vast majority of cases, it is not even the law. It is an invention. It was created in a specific place, at a specific time, by a handful of men who decided that the only thing that mattered on a scorecard was the stock price. And in the process of fixing a problem that didn't exist, they accidentally broke the engine of the global economy. Welcome to the Anti-Motivational Historian. If you want to understand why products are getting worse, why wages have stagnated, and why the stock market no longer reflects reality, you need to know this story. Subscribe to the channel, like the video, and let's look at the receipt. To understand how much things have changed, we have to look at how companies used to behave. In the middle of the 20th century, American and European corporations operated under a philosophy called managerial capitalism. The CEO of the 1950s did not see himself as an employee of the shareholders. He saw himself as a trustee of a great institution. His job was to balance the interests of everyone involved: the employees, the customers, the community, the government, and yes, the shareholders. But the shareholders were at the back of the line. In 1943, Johnson & Johnson published their credo. It listed their priorities in order. First came the doctors and patients, second came the business partners, third came the employees, and last, in the final paragraph, came the shareholders. This wasn't controversial, it was normal. Peter Drucker, the most famous management consultant in history, famously said that profit is not the purpose of a business. Profit is the requirement for a business to exist, but it is not the goal. The goal is to produce something useful. Corporations in this era retained their earnings. They didn't hand all their cash to investors. They used it to build new factories, research new technologies, and pay pensions. And the economy worked. Wages rose alongside productivity. The middle class expanded. But to a certain group of economists, this looked like inefficiency. It looked like waste. And in 1970, one man decided to declare war on it. His name was Milton Friedman. On September 13, 1970, the New York Times Magazine published an article by Friedman that would change the world. The headline was blunt: "The social responsibility of business is to increase its profits." Friedman didn't just make an economic argument, he made a moral one. He argued that a CEO who spent company money on social purposes like hiring the hardcore unemployed or reducing pollution beyond what the law required was effectively imposing a tax on the shareholders. In Friedman's view, the company belonged to the shareholders, and the CEO was their agent. Therefore, any dollar not given to them was theft. It was a seductive idea. It was simple, it was clean. It absolved executives of any moral responsibility for their communities. But ideas alone don't change behavior. You need incentives. Even after Friedman's article, most CEOs didn't care about their stock price on a daily basis. Why would they? They were paid salaries. Whether the stock went up or down, they got paid the same. They wanted their companies to get bigger, not necessarily more profitable for Wall Street. That changed in 1976. Two economists, Michael Jensen and William Meckling, published a paper titled Theory of the Firm. It is one of the most cited papers in the history of economics. They identified what they called the agency problem. The problem was that CEOs, the agents, didn't think like owners, the principals. Their solution was to flood the boardroom with stock options. They argued that the only way to make a CEO act like a shareholder is to pay them like a shareholder. If you give a CEO $1 million in stock options, suddenly he cares very deeply about the stock price hitting a certain number by the end of the quarter. We didn't just tell them to focus on the stock price, we bribed them to manipulate it. And once the bribe was in place, the character of the CEO changed. Enter Jack Welch. In 1981, Jack Welch became the CEO of General Electric. At the time, GE was known for making toaster ovens, light bulbs, and jet engines. It was a manufacturing giant. Welch turned it into a financial machine. He was the first true celebrity CEO of the shareholder value era. He earned the nickname Neutron Jack. Like a neutron bomb, he would eliminate the people but leave the buildings standing. Welch began firing workers even when the company was profitable. He cut research and development. He aggressively moved into finance. Under his tenure, GE's stock price soared by 4,000%. Wall Street treated him like a god. Fortune magazine named him Manager of the Century. Every other CEO looked at Welch and realized, I don't need to invent great products to get rich. I just need to cut costs, fire people, and financialize the balance sheet. The virus had spread. But there was one final barrier stopping companies from totally looting their own treasuries. For a long time, it was illegal for a company to buy its own stock to manipulate the price. It was considered market manipulation. But in 1982, under the Reagan administration, the Securities and Exchange Commission passed Rule 10b-18. This rule effectively legalized stock buybacks. A stock buyback is when a company takes its own cash, money that could be used to raise wages or build a new factory, and uses it to buy its own shares from the open market. This reduces the number of shares available, and when supply goes down, the price goes up. It is an artificial sugar high for the stock price, and because CEOs are paid in stock options, it is a direct transfer of wealth from the company's bank account to the CEO's pocket. Today, S&P 500 companies spend trillions of dollars on buybacks. Think about that. They're not spending that money on better products. They're not spending it on better customer service. They're spending it to engineer a higher stock price. This is why your phone feels the same every year. This is why customer support is a chatbot. This is why supply chains break the moment there is a crisis. The company has been hollowed out to feed the stock ticker. There's no better example of where this leads than Boeing. For decades, Boeing was a company run by engineers. Their priority was building the best airplanes in the world. Safety and quality were the metrics. But in the late 90s, Boeing merged with McDonnell Douglas, and the culture changed. The new leadership was obsessed with shareholder value. They moved the headquarters away from the engineers in Seattle to a corporate office in Chicago. They outsourced production to the lowest bidders. They cut costs relentlessly. They spent roughly $43 billion on stock buybacks between 2013 and 2019. $43 billion. Imagine if that money had been spent on engineering. Imagine if it had been spent on safety testing. Instead, we got the 737 MAX. 2 planes fell out of the sky, hundreds of people died, and the reputation of an American icon was shattered. This wasn't a mistake. It was the logical conclusion of a doctrine that values short-term profit over long-term survival. When you look at the scorecard more than the game, you eventually forget how to play. And here is the ultimate irony, the twist that history saves for the end. The men who pushed this theory eventually realized it was a disaster. Jack Welch, the poster boy for shareholder value, retired and watched the system he helped popularize collapse in the 2008 financial crisis. In 2009, he gave an interview to the Financial Times, and he said this: "On the face of it, shareholder value is the dumbest idea in the world. Shareholder value is a result, not a strategy. Your main constituents are your employees, your customers, and your products." The architect admitted the building was flawed, but by then it was too late. The damage was done. We are now living in the wreckage of this 50-year experiment. We have an economy where the stock market hits record highs while the actual infrastructure crumbles, where companies are stripped for parts to pay out dividends, where the logic of finance has cannibalized the logic of production. Shareholder value didn't make companies stronger, it strip-mined them. So the next time a company tells you they can't afford to pay a living wage or they can't afford to fix a product, check how much they spent on stock buybacks that quarter. They usually have the money. They just didn't make it for you. If this video gave you a new perspective on the economy, like it and subscribe. This has been the Anti-Motivational Historian. No inspiration, no hustle, just the receipt.